Morning Markets on Thursday the 13th of January. Yesterday, to celebrate the 100th episode of the Do More With Your Money podcast, we filmed a live Q&A broadcast here from head office. If you missed the session, it will be available on the YouTube channel, so I do encourage you to go and watch that video. On the session, we received several valued questions from the live audience around inflation dynamics. This morning, I wanted to touch on one of the key developments which have occurred within the inflation landscape yesterday, which was the December US inflation print. As a warm-up on screen, you can see the key market moves from yesterday. The key takeaways: we had strong positive returns experienced within emerging markets and Asia. The US was positive in local terms, however, sterling was stronger relative to the dollar, so you had dollar weakness coming through on the day. Government bond yields in the US were relatively calm despite the inflation print, but note we've already seen some quite large moves in US Treasury yields since the beginning of the year after the decision of the US Federal Reserve around monetary policy. The dollar, as I say, weakened on the day relative to a trade-weighted basket of currencies. So sterling relative to the dollar moved from around 136 to 137, so slightly stronger. Sterling was also stronger on the day relative to the euro at around 119. In terms of the US inflation print, the print for CPI headline inflation, which includes those more volatile components of food and energy, was published at 7% year on year at the end of December, marginally higher than the November print at 6.8%, so 20 basis points higher there. But the print was in line with market expectations. Therefore, the reaction in the bond markets was relatively muted. In addition, it appears that markets were taking some comfort from Fed Chairman Jay Powell after the Senate Banking Committee on Tuesday, where he reiterated the pledge to tackle inflation, and also his expectation that many of the supply chain challenges which we've been experiencing over the last 18 months are expected to ease through 2022. If we look at the various components in the report, the price of shelter, food, particularly meat, was higher. Energy, oil and gas, as we've discussed on Morning Markets many times now, was higher in that print. However, the increase from November to December in that energy print month on month was slightly lower. If we actually zoom out and focus on that headline change month on month, looking at the whole CPI print, we can actually see that the rate of inflation moderated from a month-on-month increase of 0.8% between October and November to 0.5% between November and December. So month on month, you're seeing a moderation in that print. If we strip out food and energy from the index, inflation was around 5.5% year on year for December, so up from 4.9% in November, with only a marginal tick up if we look at the month-on-month print, around 0.1% there. The Fed have already set out their stall in terms of how they intend to adjust monetary policy between now and the end of 2024 to build monetary armoury in terms of tools for managing inflation and growth, interest rates, quantitative easing and the balance sheet, but also to manage inflation there. Starting with the winding back of the quantitative easing program, which was turbocharged through 2020 to support liquidity in markets. They're doing this by reducing the amount of assets which they purchase from the market each month and starting their pathway of raising interest rates from zero bounds. The reason they are doing this at this point is to successfully manage towards their objectives around full employment levels and inflation around 2 to 3%. They're comfortable at this stage that their current actions and the data which they're seeing is suggesting that supply chain bottlenecks are starting to ease, should allow them to land at the target sooner than previously expected if they act now. In terms of what that pathway looks like, we can see on screen the dot plot which shows where members of the Federal Open Market Committee believe rates should be at given points in time. We can see that whilst we're talking about rate hikes, the moves are expected to take rates between 1.5% to 2% over the next 2 years, and this should remain supportive of financial conditions. Thank you very much for watching, and we look forward to bringing you up to date tomorrow here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.